This episode is brought to you by Koifin. Koifin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koifin.com. That's KOYFIN.com.
Hit it.
It's Friday, December 3rd, 2021.
Whoa, more pep. Try it again.
Hit it. It's Friday, December 3rd, 2021, episode 159. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show Ironsides Macro founder Barry Knapp. We have a fascinating discussion on why the current environment is more like the 1960s than the 1970s, whether we are in the expected monetary tightening portion of the correction, and Barry gives us instructions on how to never really have a bad day. Then Kuppy is back. We get an update on his thoughts on the markets, oil, and much more.
And this week in trading history, we discuss the launch of the Ford Model T assembly line, and then we end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking today?
Well, today Patrick is drinking Sangre Fresca. I think that's how you say it.
Yeah?
I think it literally means innocent blood. I think that's what it's called.
Does it really?
Yeah. I think so.
Patrick's going all vampire on us.
Yeah.
Yeah.
So Sangre Fresca is a result of cooperation of AF Brew, also known as Annie Factory Brewery, and a speakeasy bar, El Copitas, in St. Petersburg.
Yeah.
It's Russian.
It's a Mexican beer from Russia.
Yeah.
Of course.
And
But
and so,
I have to go on. There's way more.
Okay.
El Copitas opened in 2015 and since then was featured in the list of world's best 50 bars and ranked 27th in 2020. They also hosted the first ever cocktail week this year in Russia. AF Brew was founded in 2012 in the middle of the avant-garde craft revolution in Russia and hosts its own festival, Lobotomy Day.
Oh, we got to go to Lobotomy Day.
that's absolutely.
So
It's every day on the Market Huddle when you have to listen to us.
I thought I had to look it up because I thought it was maybe mistranslated, but it's literally called Lobotomy Day. So
okay, let me do our side effects. Oh no, I'm not allowed to do side effects. We have to tell everyone about the merch, Lena.
Oh, that's right. Please visit our official merch store at markethuddlemerch.com. You can get all your Lord of Crayons merch there, and we're working on other designs, but stay tuned.
All right, let me give us the disclaimer.
Do it.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the curious commodity combustions, the feckless Fed fumbles, and the Perky Powell pirouettes. All right, on to the interview with Barry. It's our great pleasure to welcome to the show Barry Knapp, founder of Ironsides Macro. Barry, I've seen you on TV for many years. It's a joy and a pleasure to have you on our show.
Thanks for having me on.
So why don't you, for some of us that, as I say, have seen you on TV on the sell side, why don't you tell people how you got into the business? Where did you grow up? How did you go to school for university for finance? How did you end up being the kind of macro strategist that you are now?
Sure. So I grew up on the campus of the University of Connecticut. My father was the first PhD in electrical engineering at UConn, spent his entire career as a professor there and going back and forth to Electric Boat, helping him design nuclear subs and that sort of thing. I was never headed for electrical engineering. I was a soccer player, was recruited heavily almost everywhere, ended up going to the University of Rhode Island, which at the time was sixth in the country in soccer. And I had a guidance counselor who suggested to my mom, I think Barry would really like economics. So here I am sitting at the University of Rhode Island focused on soccer and walk into Macro 101 and thought, oh man, this is perfect for me. Now, I'd been a voracious reader of historical novels my whole life. So that'll feed into the brand name of Ironsides Macro, which is it's never different this time, which is my use of historical analogs to try and inform the future. But so I had this interest in history. I fell in love with economics early on. I've always said I'm very thankful for a series of 3 disappointments that came within the course of 2 weeks at the end of my senior season. I was captain of the University of Rhode Island. We were the last team not to make the NCAA tournament. I was nominated for the College Soccer Bowl, didn't make it, and the NASL, the league with the Cosmos, collapsed. This is all within a 2-week period. And I say that because I would have starved as a soccer player and probably wound up as a college coach somewhere or something. But
so wait, I got to interrupt here. You must be a heck of a soccer player, and how did that come about? Because most Americans, a lot of them are at least grow up playing football, baseball, even some hockey, but it doesn't seem like soccer was that popular a sport. Am I wrong?
It was in Storrs, Connecticut. And there were pockets of it all over the country, but the University of Connecticut back in the 70s used to draw 10,000 people to college soccer games. There was only 20,000 at the university and 12,000 people in the town. So you roughly had about a third of the population at these games. My high school team was number 1 in the country. We played in the under-19 national championship. It's probably the last time a pure town team ever did that. Wow. So it was a real soccer hotbed.
And so what position did you play?
Midfield.
Okay.
Midfield. And I only stopped playing when I moved to Vail, Colorado during the pandemic. So.
Oh, mean you played as an adult, like in recreational leagues?
Wasn't very recreational. We won a couple of over 30 state cups.
Like you are a serious soccer player.
It was very serious. I was on the board of the Soccer Foundation in New York. I was president of one of the biggest soccer clubs in the state of New Jersey, coached for 18 years. So right about the time I became a managing director at Lehman Brothers, I also took over Westfield Soccer and, raced home to coach the kids every night. And one of my sort of proud things is I had work-life balance before that was a thing on Wall Street. So
that's a good bragging right. Now you said midfield. We call them halfbacks here
same difference. Generally in the center of midfield or center halfback. But
so I'm a little bit of I'm a Canadian, so we're good at hockey, and we're getting better at soccer. By the way, we do actually have a good team this year.
Yeah, we're a good national team. You just beat Mexico. I know.
Yeah, we did. Although I think that maybe bringing them to Edmonton to play in the cold was a little to our advantage. But I do know that the midfields, the halfbacks have to run a lot. So, correct. Right now, does that mean that you're still at this age running and in good shape? Like, have you maintained your soccer?
I am. I basically weigh the same as I weighed college.
Come on.
I went skinning up a mountain on Sunday, basically hiking up and then skiing back down. And so. Yeah,
okay, so listen, we'll talk about that at the end.
Colorado
so now you got me all excited because you're off in the backcountry doing all sorts of fun things there. So we could talk about that forever. Let's continue on with your career. So, so you're at school and you're lucky enough to not play professional soccer.
Right. So I fell in love with economics. I wound up with a degree in economics and minors in finance and history, took all the accounting classes and decided, I don't know anyone, but I want to go work on Wall Street. So when I graduated, I moved to New York, stayed with a couple of buddies, looked around, finally found a job as a financial advisor at Merrill Lynch in the Fifth Avenue Financial Complex, their marquee retail office in those days, and went through their training program. After about a year and a half, I looked around the office and there was 80 brokers in the office. I said, who do I want to be like when I grow up? And the answer was none of these people. So I got a job at Fidelity Investments where they would pay for my MBA, which I ended up doing in 2 years at night at Fordham University. Okay. Got an MBA in finance, and from there was able to find a job in Lehman Brothers in the equity derivatives department.
Wow. Oh, I didn't realize. What year would that have been?
1989.
Okay, and the equity derivatives, is this listed over the counter, and was it on the trading side, sales?
Everything.
Okay.
So I was primarily focused on index products. I wound up by the end of the '90s, I wound up running the distribution part of that business. My clients were the big macro hedge funds. We were doing ETF-like transactions before ETFs existed. I did my first $1 billion transaction was the unwind of the South Africa free funds when apartheid ended for the big index fund managers. I was relationship manager for Wells Fargo Nico and covered all these big, which of course became Barclays Global and then BlackRock. And so I had this, very interesting, decade, a little more than a decade in equity derivatives when it was truly innovative. We did Russell 2000 swaps before there were futures. It was a fascinating entrepreneurial, really interesting business in those days.
I'm sorry to interrupt. What was Lehman like at that point? Were they let you run with things? Was it really, like you mentioned, entrepreneurial? Was it every bit as kind of dynamic as a Goldman and Salomon Brothers in their prime?
Well, in a lot of ways, we were more dynamic than Goldman. In fact, I was with a friend of mine who was a former Goldman partner yesterday, and he was saying they had meeting after meeting trying to figure out how they could destroy Lehman Brothers. So, but when we were recruiting back in the '90s, we were the heaviest recruiters into the big MBA programs and all. And what we would tell young people that we were interviewing was, if you go to Goldman, you're going to sit next to someone and wait for 10 years, maybe longer, for them to retire to get their book of business and their seat. If you come to Lehman Brothers, you might be running a business in 5 years. And essentially, that's what happened with me. I joined in '89. By '92, I was a senior vice president. By 2000, I was managing director. In the late '90s, I was running the distribution for the flow part of the equity derivative business. So it truly was a really dynamic place. And we came a long way in a short period of time.
So you were there during long-term capital. You must have saw some
correct,
pretty fascinating things. Do you have any war stories or anything you could share?
Oh, sure. Well, that was almost the first time we almost went down. And what was fascinating about Lehman Brothers and their role in the long-term capital fiasco was there were three very big players in the CMBS market, the commercial mortgage-backed securities market. That was Nomura, First Boston, and Lehman. The two guys running the First Boston and Nomura business were PVing future profits and paying themselves fantastic amounts of money.
Come on, really?
Oh, yeah. One guy named Ethan Penner for Nomura and a guy named Andy Stone for First Boston.
Oh, I've heard that name. That's
huge paydays.
Yeah.
We were much more conservative and were reserving all of that, that present value of cash flows. Yeah. And so we actually reopened the CMBS market by selling off a big portion of our portfolio. We had no latent losses. We had plenty of reserves. And it turned out that, the rumors that Lehman Brothers had on the same positions as long-term capital were wrong. We didn't take that much principal risk in those days. Yes, we had CMBS positions, but we'd been much more conservative with our accounting of them. And we came out of that and just roared out of that. And one of the cool things that happened was Fold pulled forward the strike price on our annual stock based upon 65% of your previous year's compensation. So he did that in September of 1998. And by the time we actually got our annual stock awards, the stock had nearly doubled. So,
so you timed it better, right?
It wound up, people were so pleased with Fold in those days. Obviously, that didn't last, but but it was a really interesting way to have done it. But it also created a lot of confidence within the organization around our ability to manage the CMBS business, which ultimately is what took Lehman Brothers down, right? It was $37 billion of CMBS positions that were highly illiquid. The bid-ask spread on those positions was roughly equivalent to our capital base. And when Bank America came in to look at our books on the Thursday before we went down, they asked the Fed for the JP Morgan Bear Stearns deal and said, if you take the CMBS, we'll take the rest of the organization. And Paulson said, no, I can't do that again. And that's ultimately why we went down, was that CMBS. But
so you stayed at Lehman right till the end.
I did, and went to Barclays then for almost 6 years after that.
Barclays, the sell side, like
Correct.
okay, and so
Barclays bought the U.S. broker dealer, and
when you stayed with
part
them,
of that deal.
okay. And so, what did your role change at Barclays?
It had already changed considerably. So by the early 2000s, the equity derivative business had become fairly commoditized and not as innovative as it had been before. I was, at that point, essentially the internal strategist, and I moved from the sales distribution part of the business into a principal trading role. I wasn't facilitating customers' orders. I was actually trading Lehman Brothers capital and performing an internal strategy role where I sat at all the big global risk meetings and with all the biggest traders around the firm. And
so you definitely had a ringside
department.
So Barry, you definitely had a ringside seat for the fall.
Yeah, I absolutely did. I absolutely did.
So now at Barclays, did you take the same role or did it change again?
In May of 2008, I'd been getting asked for a number of years, would I move to the research department and take the equity strategy job? And I often said if I'd worked at Morgan Stanley, I would have done it in a heartbeat, because they've had some really amazing people sit in that seat, including Byron Wien.
Right.
At Lehman Brothers, we'd had a little more storied history of people in the equity strategy seat. There was Elaine Garzarelli at the time of the crash. Jeff Applegate, who was a very smart guy, but went down with the tech bubble, still promoting his technology favorites. And I was a little uncertain about moving into research, but by May of 2008, I had agreed to take on that job, partially at the urging of people like Bart McDade, who became the president at the end, and Rick Reeder, who's now the CIO of Fundamental Fixed Income and runs a global asset allocation fund at BlackRock. So I had agreed to take that job, but when we went bankrupt, I hadn't actually published the research report before.
Okay.
Or as of yet. But I had officially moved into research. And so when Barclays took us over, I launched my equity strategy product in October of 2008 and remained in that role through mid 2014.
And so how did you enjoy it?
I liked it a lot. It was actually a great job. Really interesting. I got to talk to smart people. I got to really do a lot of research. It was what always interested me. I got to think about things from a little longer term duration. And I went into the role having, communicated with hedge funds and trading internally, thinking about shorter duration ideas. And then eventually was in meetings with people like the Capital Group, where they give me effectively, hey, Sonny, tell me about something that's going to work over the next 5 years, not the next 5 months or 5 minutes. And it was a fascinating metamorphosis in terms of my thought process about investing and how people approach things, and began to appreciate the long only money community in a way that I never had before, because having been in equity derivatives, I dealt with hedge funds and highly structured investors and asset allocators and the like. So it was a great job, actually. I left only because I had an opportunity to go to BlackRock to move into the fundamental fixed income area, help manage the unconstrained fixed income funds. It looked like it was going to be a very cool job. I'd effectively be the director of research. I'd manage the equity risk. And also help with the marketing and bringing in of money, which is so crucial at BlackRock. I got there, and that the move from equities to fixed income was not what I thought it would be. It was too focused on risk management, a little too sedate, or not as volatile as I'd been accustomed to.
Not only that, Barry, you sound like you're much too optimistic to be a bond trader.
Yeah. Well, that's funny that you say that, because a very famous Lehman equity derivative quote is equity people are always more optimistic than bond investors or bond traders, because the best you can get as a bond trader is par.
That's right.
But anyway, so I did that for 2 years and then decided that really wasn't for me. I spent 9 months thinking about, all right, of the things you've done over the last 25 years, what do you really like? And what I liked the most and what intrigued me the most was that equity strategy, macro strategy role. Now, I obviously had a broader background than just going back and sitting in an equity strategy seat. I had an opportunity to do that at a couple of places, but decided, no, I wanted a bigger mandate. I ended up going to Guggenheim Securities with some ex-Lehman partners. Turns out Guggenheim Securities is really an investment banking boutique. They haven't gained all that much traction with their capital markets business, and it really wasn't an optimal place for someone who wanted to talk to, big long only money managers, global investors, asset allocators. It just was a mismatch between the rest of the products on the floor and what the salespeople were focused on. So that's when I decided to start Ironsides Macro back at the beginning of 2019.
There you go. And it's been all uphill from there. So let's talk a little bit about at Ironsides, Ironsides, sorry, I keep saying sides, what you're seeing in the market. And one of the things that intrigued me a lot was you wrote a piece about how everyone is comparing the current environment to the 70s with increasing inflation and a Federal Reserve that's relatively accommodative, at least before was relatively accommodative, and how we were going to have a repeat of the 70s. And your pushback was, this actually looks a lot more like the 60s. And I found it a really compelling argument. I'd love for you to sketch it out for us.
Sure. I originally got started on these analogs back in 2010 and 2011 when I really started to study financial repression, in the aftermath of the global financial crisis, thinking about various debt crises. And it immediately occurred to me through the various research I was doing, looking at explicit interest rate caps during World War II through the beginning of the 50s, comparing that to quantitative easing. It occurred to me that there were vast similarities between the 1950s and the 2010s. And one of those factors was those explicit interest rate caps that the Fed and Treasury agreed to in 1942 and only finally removed in 51. But even then, they only removed them slowly. We had similarly restrictive bank regulatory policy. The return on equity in the banking sector never got above 10% in the 50s, as was the case through most of the 2010s until the very end. You had very uneven growth, weak capital investment. And while a lot of people will look back at the 50s as, gee, this was a period where we really didn't have any global competition, in fact, growth was very uneven. We had 5 recessions from the end of World War II through 1960, and it really wasn't a great period for growth, but we had fantastic equity returns. We went from a 7 PE at the end of World War II to a 20 PE by the time JFK was elected. When JFK was elected, things started to change decidedly for the first time, in at least post the Great Depression Fed reforms. You had expansive fiscal and monetary policy. JFK was elected, and initially, I should say, his fiscal policy was not dissimilar from the Tax Cuts and Jobs Act. They changed depreciation schedules to try and encourage investment. It was done post-mortem after he was assassinated, but they had a tax cut that cut corporate tax rates, cut individual tax rates. In many ways, the supply side reforms of the JFK administration were similar to the Tax Cuts and Jobs Act. But what began to happen under LBJ was you then had very expansive fiscal policy, but not by cutting taxes, instead by increasing spending. And whatever you think about the societal goals of that at the time, for example, only some 25% of Americans over the age of 65 had health insurance. So the introduction of Medicare was, I suppose, a social or moral imperative. But if you then look at what happened to inflation after Medicare, Medicaid were passed, it really started to accelerate, going from just under 2%, a 1.5% or so trend, all the way to 5% or so by the time LBJ left office. So, yeah, it was the right thing to do, but it really did come with a cost, right? It's Thomas Sowell. There's no policy solutions, there's only trade-offs. Well, in this case, one of the trade-offs was inflation, and you had very expansive fiscal, very expansive monetary policy. Bill Martin, who was the chair of the Fed at that time, was often quoted saying the Fed is independent within the government, not of the government.
Oh, I didn't know that quote. That's a great quote.
It is an awesome quote. I've used it with Joe Kernan a couple times. I figured he would love that on Squawk Box. But in addition to that, although the Kennedy administration and later Johnson administration gave lip service to the dollar gold standard, Bretton Woods was not supposed to work the way it ended up working, meaning as nations started running big current account surpluses, they were supposed to revalue their currency. So by the early 1960s, Germany and Japan had fully recovered, were running these big current account surpluses, but refused to revalue their currency.
Okay.
France then started to grab every bit of gold they could out of the U.S. Reserves. The night that JFK was elected, the price of gold rose 25% in London under the idea that Kennedy would force a revaluation. He didn't do it, but gold steadily got drained out of U.S. reserves through the course of the 70s to the point we know the end of this story, which is in August of 1971, Nixon ended convertibility into gold and effectively blew up Bretton Woods and ended the dollar gold standard.
Sorry, didn't mean to interrupt that, Barry. So you're saying that actually started in the 60s, like the
correct.
Handwriting was on the wall from the moment that almost from Kennedy got elected.
That's right. That's right. And it just continued through that entire time period. And as inflation accelerated, as I said, France and some of our other partners were constantly redeeming dollars for gold. And you look at our gold reserve holdings and they just fell steadily throughout that entire time period. So there's lots of similarities from a global trade imbalances perspective, from having expansive fiscal and monetary policy. If I had to pick a point in time where we are right now, it is 1964, 1965 roughly, where we have policies that the Democrats view as moral imperatives, expanded childcare and community colleges and all these other things, but they'll come with a cost. And green energy will also come with a cost. And there's a key difference between the 60s, though, is energy prices remained fairly subdued through that entire time period. It wasn't until the supply shocks of the 70s that the prices really exploded. Well, we don't have that same dynamic today. So, but nonetheless, what's important about that period from an investor perspective, and my basic thesis here is we went through a couple of decades of disinflation, just as we did in the 50s and first half of the 60s. We didn't go straight to inflation. We went through a period of reflation. And what I mean by that is when inflation went from 2 to 4, that was eminently manageable for the corporate sector in particular and the household sector. Nominal wage growth picked up. Household sector sees nominal wage growth pick up, consumption picks up. They may be losing a bit on balance, but they won't recognize it immediately until inflation gets to a level where it becomes particularly concerning. In fact, there was a Fed economist who wrote a paper recently about why should we care about inflation expectations. His name is Jeremy Rudd, but he did postulate that above 4%, and I realize we're above 4% now, but most economists would expect inflation to settle back below that level next year. The question is, where's the underlying trend? Because above 4, it starts to get to a level where it really becomes embedded in household expectations and becomes difficult for the corporate sector to manage. And what I was starting to say with respect to the corporate sector is the path from 2 to 4 is okay because the majority of costs are actually fixed. And so if your revenue growth goes up, your fixed costs don't change immediately. It falls to the bottom line and you have operating leverage and stronger profit margins. And that's been one of the surprising dynamics of 2021 is that profit margins went to all-time highs. A number of equity strategists got that wrong and have been negative, thinking that there was going to be profit margin pressure, and it hasn't occurred yet. So the idea is going from 2 to 4 is fine and actually a positive for the corporate sector. I should note that earnings growth in the 50s averaged 8%. It averaged 15% from 60 to 67. So although the PE had gone to 20, it held that higher valuation level in part likely because earnings growth was so much faster. So that reflationary regime was actually a plus for investors. No, you weren't going to get any multiple expansion, but you got stronger earnings growth, and that led to pretty good returns through that period. It would be, and so this is in essence my thesis, is that we go through a period of reflation, and then we'll see whether policymakers repeat the mistakes of the late 60s and ultimately 70s, where they don't have the political will to put the inflation genie back in the bottle.
Okay, so let's talk a little bit about the timing, because I think this is one of the problems with the market is the market gets ahead on so many of these things, and we went from disinflation and believing that COVID was going to cause, a collapse in a return of deflation to, oh my God, it's filled on all the doom financial sites that we're going to have hyperinflation. We have Jack Dorsey talking about hyperinflation. It's kind of running from one side of the boat to the other. And what I love about your analysis is much more steady in the middle, but yet it's still also saying that we are going to have higher inflation in the coming years. So if I understand it correctly, you're saying that that what we should expect is something similar to 64 to 69, where we see this higher inflation, and yet though the profit margins stay high enough and equities actually do well enough to not cause a collapse.
Here's the way to frame out inflation. If you break inflation into three major components: energy prices, and we've had decades where energy prices have driven inflation higher, and others where it's been deflationary or disinflationary. So we'll set that aside for a minute, and then look at core services prices, and core goods prices. All of the disinflation we've had in the last couple of decades has come through goods prices.
Okay.
And the explanation for it is simple and obvious when you think about it. In 1990, there were 750 million industrialized workers. By 2010, there were 2 billion. And that's a consequence of the integration of China and the Soviet bloc into global goods supply chains. So if you then look at it even more closely, what you see is global goods or core goods prices were falling at their maximum rate, negative 2.4%, I believe, in 2003, 2004. Shortly thereafter, China had been admitted to the WTO.
Yeah.
So that disinflationary impulse from goods prices came from a very obvious source. Now, if you step back and you look at the growth in global trade in the 90s and in the 2000s relative to industrial production, global trade grew much faster than industrial production, right? This is the period of globalization where U.S. companies in particular are capitalizing on that cheap labor and outsourcing and that whole globalization dynamic. That slowed decidedly in the 2010s. There was some great work done on this in early, call it 2011, 2012 by the Boston Consulting Group called The Tipping Point, and they forecasted by mid-2015 that productivity adjusted relative labor costs, increased transportation costs, supply chain risk, currency risk, all those things would render manufacturing in China to sell all over the rest of the world no longer economically feasible. Now, or economic, just generally economic. Some businesses adapted to that. Some didn't, right? Apple still makes the majority of their products there. What you needed was a series of supply chain shocks in order to get businesses to actually say, no, I can't stretch my supply chains all over the world any longer. So those shocks actually began all the way back in 2011. You had the Great East Japan earthquake and tsunami that shut down the auto industry for 3 months. You had floods in Thailand later that summer that shut down semis and parts of electronics. Then you had the Trump trade war. Then the mother of all shocks in 2020 with the pandemic.
Right.
So now, if you think about that, right now, core goods prices are running at about 9%. They're not going to stay at 9%, but they are no longer going to be a negative impulse. Supply chains will get restructured, and that will probably prices will probably start increasing at around 1% to 2% even. core goods price or core services prices, have been running at 3% for that entire time period, right? So domestically determined service prices endogenous to the U.S. economy have been running above the Fed's target for this entire period. They've been simply capitalizing on this, goods disinflation. You could delve into some other topics too, Amazon and the internet influences on those goods prices, but most of those things are now over with. So what you're looking at as you get into 2022 is, sure, goods prices will come down, supply chains will clear, and we'll no longer have that 9% core goods price inflation. But as you start to move that consumption basket back towards services, what you're going to find is the only thing really transitory about inflation in 2021 was disinflation in education, healthcare, and at the beginning of the year in housing. That's when the policy effects of expanding, Obamacare eligibility and sending child care credits to households and expanding education to pre-K and all those things will start to impact those prices. And we'll find that trend inflation is running significantly higher because of policy. So this is, again, if you look at how this occurred in the 70s, middle 60s, it grew slowly, right? Medicare was initiated and healthcare inflation started to rise, and it took several years before it really got to the point where it was really driving inflation above that 4% threshold level. So this is what I think will occur in 2022 is early on, we'll see those supply chains start to clear. We'll see the goods prices come down. Investors will breathe a sigh of relief and think, okay, this is all good. The Fed can go slowly. And then we'll realize that policy has driven service sector price inflation to a higher level than it was at in the 2000s and 2010s when monetary and fiscal policy were not both expansionary. And that's when, we'll start to move into that reflationary regime.
So one of the kind of interesting points about this last little episode in the market is that the inflation break-evens, inflation swaps, they've all assumed that the inflation is going to be short-lived, whether it be a year or two. The front end of the curve has gone crazy. And as you look out in longer-dated break-evens and swaps, that it has moved a lot less. How do you reconcile that? And do you think the market is making a mistake? And if so, when do you think they'll recognize that?
I think as the process that I just described, goods inflation coming down, but services inflation starting to rise, we'll begin that process in call it first half of 2022. I would add to that point, there's a pretty substantial debate about the terminal funds rate, or what the Fed calls R star, the equilibrium rate, what Wixel called the natural rate of interest. And even one of my old colleagues, Rick Reeder, was on Bloomberg today saying, I don't think interest rates can go up all that much. So I strongly disagree with all of that. And I'll give a couple
One second, can I just interrupt? Because I think Rick is causing the euro dollar, the 2024 December euro dollar to invert with the 2025. And if you look, it's very unusual, and it's because they think that they will have reached the terminal rate by then, I believe, if I understand correctly.
Right. And in fact, I'll go through a couple of elements of my view that the terminal funds rate is going to be significantly higher. I actually agree with Bill Dudley on this for slightly different reasons. Just as an anecdote, he was a member of my golf club back in Jersey, so I know Bill. But
okay.
Anyway, full disclosure. So Mohamed El-Erian this morning described the U.S. economy as a highly leveraged economy, and that's part of his primary explanation why we can't get to a higher terminal funds rate than the 2.5% that we stopped at last cycle. Okay, sure. When you look at the total amount of leverage in the U.S. economy, it has gone up. But where that leverage resides is crucial to thinking about how that will impact the economic actors' policy and behavior. We had the highest level of household debt to disposable income, or GDP, in history in 2008. We're now back down to about 2000 levels. financial obligations ratios, which is the percent of interest payments that go to disposable income, are at their all-time lowest levels since the Fed started measuring that in 1980. So the household sector is not indebted. And when you look at household net worth, it fell from $70 billion to $59 billion during the global financial crisis over an 18-month time period, and took till late 2012 to regain that level. Household net worth during the pandemic fell from 17 at the end of 2019 to $111 trillion, and then roared to $140 trillion today. So think about the household balance sheet. Much higher net worth, which is soaring, much lower debt, and much lower or much more positive cash flow as a consequence of interest payments being so low relative to disposable income. So the household sector is in great shape. There was lots of talk about the non-financial corporate sector debt going up as much as it did last cycle, record issuance and the like. Well, we had an 11-year expansion, and it went from 41% of GDP to 49% of GDP.
Right.
That's a very slow level. And most of the academic studies that have been done over the years, guys like Stephen Cicchetti, the Reinhardt and Rogoff stuff, all seem to believe that the threshold level for the non-financial corporate sector or household sector level of debt to GDP that would slow growth is something closer to 90%. And then, of course, the financial sector, massively deleveraged as well. All the debt's at the government level is the bottom line here. And when all the debt's at the government level, the first order of business for the government when they decide they have too much debt, and the government's coming to that realization, they'll realize it even more strongly in November after the Democrats likely get smoked in the midterms. But that notwithstanding, the first step is to try and raise taxes. The second step is to try and inflate their way out of it through financial repression. So, government debt is inflationary. Household private sector debt is deflationary. So I strongly disagree with Mohamed El-Arian on this. It's a highly leveraged economy, but where the debt resides matters a lot. And then just to give a little more color on why I think the terminal funds rate is higher. In 2018, when we reached 2.5%, and ultimately the Fed had to do their midterm or mid-course, mid-cycle easing, that did not happen because interest-sensitive sectors started to slow. Housing did not slow. It was very stable through that whole time period. Auto sales did not start to slow. Durable goods purchases did not start to slow. Donald Trump caused a global manufacturing and trade recession. It's the first time in 30 years where you had negative global trade and positive GDP through his trade war. And ultimately, if you think about the role of the dollar in global trade credit, 50% of global trade credit before the global financial crisis was denominated in dollars. It was 80% by the mid-2010s. So that meant demand for dollars went up. That choked off global trade credit. That exacerbated the downturn in global trade. The role of the dollar in global safe haven assets has increased as well. Guys like Krishnamurthy from UChicago and the Hoover Institute have written about this and published papers at the Jackson Hole Symposium. So all those things caused that yield curve inversion and caused the Fed to ease, but we did not reach the endogenous terminal funds rate. That was a policy mistake. I suppose I'm calling it a mistake. Others might disagree. Certainly Trump would disagree, but that notwithstanding, that's what caused us to reach the terminal funds rate. So we never actually reached the point when the U.S. economy couldn't handle that level of interest rates. It was a policy shock that caused the Fed to have to ease. And then if you think about productivity growth, which is likely to be much stronger, it was already accelerating last cycle. That's something that Williams and his staff have viewed as a factor in R-starred. That's likely to be higher next cycle. The pandemic was a positive productivity shock. And there's a number of other factors that will likely push that terminal funds rate higher. So I just come out in a very different place. And I think, the market's wrong about it now. But a final point I would make on this, if you think about what you described on break evens falling as sharply as they have over the last couple of weeks. 2 weeks ago, prior to the Omicron variant and the Fed effectively pre-announcing that they were going to accelerate the pace of the taper, if you looked at the 5-year part of the curve, which is, remember, the Fed's average duration of purchases is 6 years. So that's right in the crosshairs of Fed purchases. 5-year inflation break-evens were at an all-time high, over 320. 5-year inflation break-evens were within a stone's throw of their all-time low. So it was really the Fed's distortion in this part of the market. And even still, I sent around, as part of my weekly note, I sent around the real rate curve from 2 years out to 30 and showed how, even though the Fed was ostensibly tightening policy, that real rate curve was lower than where it had been at the time of the September FOMC meeting, the June FOMC meeting, or even August of 2020 when nominal rates bottomed. So that just underscores how easy Fed policy is relative to, actual economic dynamics and where the market's head was at in terms of what the inflation outlook is. So I think we're going to find that through 2022, as the Fed accelerates the end of asset purchases and perhaps even goes directly to balance sheet contraction, that we're going to start to see some normalization. And I think that terminal funds rate outlook is going to slowly shift significantly higher.
And so when you think about this from a longer term investment perspective, if you believe that inflation's headed higher for many of the reasons, and by the way, I completely agree. I think that people are underestimating the how good the private sector's balance sheets are, both on the consumer and the corporate side, because a lot of the money they raised last year on the corporate, they actually just left in cash. It was kind of rainy day money, right? And I look at it and I just go, the consumer's going to keep spending, the consumer's going to buy houses, and the private sector is going to do capex because they have to reshore a lot of their production back to America. So to me, it looks like the markets have given up on private sector credit creation just as it's about to finally take off. But if we think about this, when you're thinking about how you construct a portfolio, does that mean you're underweight bonds and it's something you view as a risk going forward?
Yes, and one of the titles in my Outlook section is another difficult year for the 60-40 model. And so I do think bonds are going to struggle. And that is, by the way, the story of the 60s, where bond returns were negative, although equity returns remained strong. And that correlation between that stock bond correlation shifted significantly during the 60s. So that is very much where my expectations are, my asset allocation idea is. And although Ray Dalio says cash is trash, cash is your risk mitigation instrument in my view right now, because as the Fed withdraws this policy, and I'll give an example as to how to think about this, but as they withdraw policy, we are going to have a series of shocks that cause market corrections. Those corrections will generally be buying opportunities, but having some cash around will allow you the opportunity to take advantage of that. So here's a way to think about that, and then this intersection of economic growth and liquidity. So every business cycle since World War II typically had one, what I'll call monetary policy correction. And it came at the point when the Fed gained enough confidence that the economy had achieved, I'll quote Muhammad al-Arian, escape velocity. And the Fed would start normalizing policy, whatever their tool was at the time, their favored tool. And that would cause an 8% equity market correction that would last for roughly a month and a half to 2 months. It would cause it would be reversed fairly quickly, and then the market would go on its way. It was never terminal for the business cycle. It was never terminal for the associated bull market. Last cycle, we had 8.
Oh.
And that occurred after the end of QE1, QE2, Operation Twist, QE3, the end of zero interest rate policy, and then we had 2 during balance sheet contraction. So this intervention from the Fed will cause, fairly significant drawdowns. Now, if you think about the outlook for 2022, and you think about the liquidity environment in early 2022 compared to early 2021, in early 2021, the Treasury had $1.7 trillion on deposit at the Fed in their what's known as the TGA or Treasury General Account. They drained that all the way down to about $100 billion over the course of 8 months. And the way they did it was initially they sent checks as part of the bipartisan omnibus bill at the end of 2020, and then the American Recovery Plan in March of 2021. But then they cut Treasury bill issuance. And so during the pandemic, bank cash assets went from $1 trillion to $3 trillion. So it just dumped this massive amount of liquidity into the system, much of which wound up back on deposit at the Fed in the RRP program. So it was somewhat trapped in the system. But let's face it, some of this leaked out. The fact that the meme stocks went crazy and crypto went crazy when those checks were all sent out to individuals, and there was a proliferation of new Robinhood accounts and so on and so forth, was no accident. And then, of course, as the Fed cut Treasury bill issuance, we had a ferocious rally in the second quarter of last year in the Treasury market, and banks bought $500 billion worth of Treasuries because they had nothing else to do with the money at the time. There wasn't demand for credit, which, by the way, is picking up now. You also had the Fed buying $120 billion a month and those aforementioned checks going out. So we had this really liquid environment. Fast forward to today, when we get a debt ceiling agreement, the Treasury is going to increase issuance and build that Treasury balance back up to $500 billion or so, draining that money out of the system. The Fed, of course, purchases are going to go to zero by March or April, depending on just how they accelerate the taper. And there'll be a few checks going out, but if Joe Manchin has his way, they're only going to people with incomes under $60,000, and they'll be means tested and they won't be that large. So it's a very different liquidity environment. Now, here's the rub on all that, though. It's actually not going to be an economic negative. In some ways, could wind up being an economic positive. And here's my logic in that. The banking system going from $1 trillion in cash assets to $3 trillion in cash assets, that the best they could earn on much of that is 5 basis points, was a drag on profitability. They don't want those assets, right? They ran into their supplementary leverage ratios in March, and then again in June, they had to sell a whole bunch of bonds. The best they could do with the bank debt was to turn around and buy treasuries with it. And of course, treasuries yield, the return they were going to earn on treasuries was less than their cost of capital. So again, a drag on profitability. As that money gets drained out of the banking system, they're plenty liquid. Profitability will go up. Their marginal propensity to lend will likely to go up, and the banking system will be better off, not worse off. Well, if the banking system's better off, not worse off, chances are the macroeconomy will be better off, not worse off. So this is the tricky dynamic that will occur in the first half of 2022 is you're draining liquidity. We've seen it even in recent days. High valuation story stocks have just been getting absolutely crushed. But the underlying fundamental story is likely getting better, not worse, assuming that we don't find out that Omicron isn't significantly more deadly than Delta, but we'll leave that aside for now. And that's, I think, going to be the tricky part of the first half of 2022 is you're draining liquidity, but the fundamental story is getting better.
And in some ways, I would argue it's actually a positive because we've had these, as you say, the meme stocks, these other assets that have just been in never land in terms of their valuations. And it almost has made a farce of the market in a lot of ways. And if we get a return to fundamentals where actually the underlying economy starts to matter and stuff, I can't help but think that's a positive over the long run.
My next door neighbor said that exact same thing to me when I was walking my dog a little bit earlier today. He said, "At least I know what's going on in Vegas, But I would wholeheartedly agree. I mean, the just valuations in parts of the market are absurd, and so when you look at the overall story, it just doesn't look like it did in the late 90s for most stocks, for most sectors, Again, it looks a lot more like it did in the early or first half of the 1960s, and the fundamental story is getting better. We haven't, when you think about, you didn't bring up the 90s, I did, but when you think about what had occurred in the 90s or in the 2000s, we had true underlying fundamental investment bubbles. So non-financial or non-residential fixed investment grew at almost 10% per year throughout the 1990s, which at the time was the longest business cycle we'd ever had. So you really did have an investment boom and then subsequent bust. Of course, in the 2000s, we had a housing boom, actual underlying economic residential investment boom, and then bust. There's been no such underlying economic overinvestment boom that could then lead to a bust this go around. We have asset prices that are exceptionally elevated, and I would argue because of all this liquidity and what was likely a Fed overreaction to what was the shortest recession on record. If we could somehow take the froth out of that part of the market without causing any undue damage and without any leverage in the system, it's unlikely it will cause undue damage. Because even when you compare that 90s or 2001 recession to the 2008 through 9 recession, consumption never even went negative in 2001. So
you kind of beat me to my next question, because I was thinking as you were describing this environment that you see in early 2022 and the shift away from the kind of almost the financial economy to the real economy, I wonder, I think about all the hedge funds and all the asset managers out there, and I'm pretty sure that everybody is long all of these growth stocks. They've been hiding in large cap tech. All you have to do is look at the capitalization of the 6 biggest stocks in the S&P 500 to realize that that's where they are. With them being so overweighted, do you think we couldn't get a shift like out of those stocks into the real economy stocks, into the bank stocks, if you believe that they're going to be more profitable without a market event? Like, can we do that? Can we do that shift without a down 20% or down 30% correction?
I think we can. I think we can do it with, periodic down 10% drops. The only caveat I would put on that is that there were some differences in the 2010s as the Fed was unwinding policy relative to those earlier periods. So, in 1994, when the Fed doubled the Fed funds rate from 3 to 6 in a year, the max drawdown for the S&P 500 was 9%. In 2004, when they did the measured removal of policy accommodation, it was 8.5%. The average in the 2010s was closer to 12%. And we had a couple of big ones, as you remember, 2010, 2011, when we had fiscal policy and monetary policy tightening simultaneously, we had a 19% drawdown. But we had a much weaker underlying fundamental dynamic, right? We still had excessive debt, household net worth, balance sheets were still impaired. The underlying fundamental story was much more tenuous than it is this go around. So my expectation is these will be primarily market events. And no, I think the Fed put strike is much lower than it was because of what I described earlier on household net worth. So it's not as if the Fed will come rushing back in and restart QE. But I do think it can be a bit more isolated. It's probably a good point for me to add at this level. I do think there is likely to be a fundamental shift away from tech towards the rest of the economy this cycle. And here's the analogy or analog I would draw with that. So when we had that tech boom in the 90s, one of the things that was really built out was fiber optic capacity, right? So supposedly by the early 2000s, when Global Crossing went under and WorldCom went down, we had something like 25% capacity utilization of fiber optics cables. Well, that benefit ended up accruing to the media sector who started streaming, and it was taken up much faster than we thought. But because there was all that excess capacity, I recall in those days, people believing that the market couldn't rally without tech leading the rally. Of course, tech never outperformed during the 2000s. After the crash, it just became a market performer, and other sectors led the rally, financials and energy, namely. I think we've had something similar, though not nearly as acute over the last 10 years. And that was the build out of the cloud and digitization. So that cloud growth is still rapid, but it's not nearly as profitable as it was. If you look at Google, for example, they seem to lose $1 billion on their cloud expansion every quarter. And so my thesis here is that the benefits of digitization, the movement to the cloud, are going to start to accrue to the users of that technology from the or consumers of that technology from the producers of that technology. Healthcare is a great example, right? Telemedicine. Healthcare has been the biggest drag on this country's productivity for 30 years. It has the biggest contribution to S&P 500 revenues, but not nearly the biggest contribution to S&P 500 earnings. Margins have been falling for 30 years in that sector. The industrial sector clearly can build out the Internet of Things and become much more efficient. That's happening in the financial sector. It's already occurred in the consumer sector, particularly in consumer services in the late 2010s. That's what caused productivity, which ran at 1% from 2010 through 2017, to accelerate to more like 2% in 2018 and 19. That was service sector productivity because manufacturing productivity went negative. So that's my thesis for tech. Now, I wouldn't be underweight tech. Being underweight U.S. tech is a tough call, but I do think that benefit of that whole build out of the cloud of digitization starts to accrue differently. How we make that transition, can we do it without a big 20% drawdown? I think we can, but we may have some dicey moments, including the current environment, today's trading.
Right? Well, that was my next question. Do you think that this is the start of the you described how typically there was one monetary event as the Fed withdrew liquidity and then the market realized it wasn't as bad as they thought, or tightened conditions. I'm sorry, not withdrew liquidity, tightened conditions, and the market realized it wasn't as bad as they expected, and then it caused the correction, which then eventually just the bull market resumed. Do you think that this is the start of one of those?
I do. Okay. And so I had a forecast this summer, and my framework for the market this year was all drawdowns would be limited to 4 to 6%. They'd be sentiment based until and unless we got significant policy tightening. So when it became clear to me that the Fed was going to end the asset purchases, I had a forecast that we would have a 10 to 12% drawdown around the time of the taper announcement. In September, we had a 6% drawdown and it stopped. That drawdown had all the makings of Fed policy normalization related correction. We had a nearly 40 basis point increase in 10-year real rates or TIPS yields. That's what happened in the two shocks that we had in 2018. It was fairly highly correlated at the beginning. I thought it was going to be worth 10 to 12%, and it stopped at 6%, partially because of seasonality, partially because earnings were good, partially because the economic outlook was improving. The Delta wave was easing. By the way, the Delta wave didn't really cause that much of an economic slowdown. If you measure growth using gross domestic income instead of gross domestic product, and I would argue that's actually a much better measure for investors, but story for another day. This again, although the pullback here started as a concern about the variant, it's quickly morphed into being more about liquidity, more about tighter Fed policy, and I think we're going through another one of those shocks. So
10 to 12%.
It could be 10 to 12.
Yeah. I was with you, Barry. By the way, I thought it had started last time in September as well. I was shocked when it stopped at 6. I said I thought we were heading to 10.
What I would tell anyone listening to this ultimately, though, is those were your best entry points in the 2010s, were those Fed policy normalization related drawdowns. Now, I wasn't in a strong position to buy the big drawdown in 2009, having just had a significant portion of my net worth wiped out when Lehman Brothers went bankrupt, 5-year cliff vesting, But the 2011 one in particular, I thought was a huge opportunity. I pounded the table as Barclays equity strategist, and I did the same with my personal account. And that turned out to be a tremendous opportunity to enter the market. So to me, these are your fat pitches. When we have these Fed policy normalization related corrections, when investors think that the Fed is going to choke off the expansion and send us back into recession, And I have every reason to believe, for all the reasons we've discussed, that no, this will not impact economic growth. And in fact, it'll wind up creating a much better, healthier investment environment on the other side. So when you get these 10% pullbacks related to Fed normalizing policy, those are your windows of opportunity.
Barry, I could do this all day, chat with you. It's wonderful to listen to you, but unfortunately, we have to let you go. It's Friday night. Why don't we're gonna learn more about Ironsides Macro, but before we do that, I'm gonna ask you our 4 questions that we like to end with. First of all, your favorite investment book.
My favorite investment book. I'm a big Hayek fan, and most people who've read Hayek have thought about have either read The Road to Serfdom or The Fatal Conceit. The Fatal Conceit is particularly good. But I think the Constitution of Liberty, if you really want to think about the interaction between policy, politics, and economics, that book's a little bit of a slog, but it is just dynamite to think about how the public and policymakers try and influence things. And it gives you a perspective as an investor that I think is tremendous. So it's not exactly an investing book, but for me, it's very important because a lot of my work is based on policy.
Barry, you're going to win Deep Cut book recommendation award for that for sure. Okay, let's go.
By the way, let me just throw one other book out there for people that want to think about deglobalization and global trade.
Yeah.
There's a book called Clashing Over Commerce by a Dartmouth professor, Doug Irwin, that goes through the history of trade in the U.S. from the Revolutionary War all the way up almost till Donald Trump. And it provides tremendous perspective on thinking about global trade. Again, another really good read.
Okay, my next question is, are great traders or investors you pick born or made?
It's a difficult one because I've sat in the room with Dave Tepper, for example, and the man is just a genius, and his ability to be able to take complex topics and break it down to simple ideas is almost incomprehensible. So I just think that was instinctual with Dave for some reason. I grew up the son of a college professor. I knew nothing about the markets. It was never discussed in my house. And I've spent a lifetime studying and reading and think I'm fairly good at it. So I just think it's there are some that are clearly born, but you can make yourself into a pretty good one as well.
The rest of us can work on it.
Wishy-washy on that one, but
no, it's all right. It's a great answer. And Tepper is really one of the underrated, awesome risk takers out there.
Fun guy to have a meeting with, too. I'll tell you that.
I can imagine. Okay, my next question is the Byron Wien surprises of the year. Byron describes them as something that the market thinks has a less than 1/3 chance of happening next year, but he believes has a greater than 50-50 chance. If you could come up with one surprise for 2022, Byron Wien style, we'd appreciate it.
We spent a lot of time. Here's the one. So because I think that productivity, we already had a productivity boom underway, because I think we have a strong capital spending environment, and I've got a whole host of reasons why I think that's likely to occur. I think profit margins are going to continue to expand in 2022, and I think that's probably not consensus. I would expect, and I listened to a couple of strategists just in the last few days that expect that margins are going to come under pressure because of rising wage costs, because of supply chains, all these other issues. I think profit margins are going to expand further. I think my inflationary regime and operating leverage is going to hold up, and we're going to find we are at even higher profit margins at the end of 2022. So that one might be more like, I'm not sure it's only 1/3 of the people that think that's going to occur, but it's probably a low number.
Oh, I think you got it for sure. Okay, last question. If someone is a young college graduate is saying, what should I do to get into this business? What advice would you give them?
The advice I always gave young people that came into the business when we were interviewing them back in the Lehman Brothers days, when we were so prolific in hiring, is I would always tell people, you really need to love the markets, love economics, every day is exciting when you walk in the door and you want to find out what happened in Japan or China overnight. You truly have to be completely fascinated and intrigued by the business. Otherwise, it's just going to be too difficult. And I used to joke about it and say the jerk quotient on the street was so high because of people that really were doing it for the wrong reason. And if you loved it, you'd never have a bad day. And if you truly were interested in the markets and economics, you never really had a bad day, no matter how hard a time people gave you. Clients, traders, managers, all of that. So that's my advice. And if you love it, you'll find a way into it, and you'll come to work with a smile on your face every day, and that'll be infectious, and people will want to work with you.
That's terrific. Okay, so you mentioned your new service. Why don't you tell people a little bit about it, what you offer, how they can find out more about it?
Sure. So Ironsides Macro, my website is housed on Substack. So it's ironsidesmacro.substack.com. I write fairly extensive 2,000 words, 10 or so figures, charts, and tables every week. I have investment ideas in there. I have a tactical trading strategy I've recently introduced. I'll put out notes during the course of the week if there's something that I think warrants immediate comment on. And what's really interesting about that is when I was Barclays equity strategist or worked at Guggenheim, the only people that got access to my work were institutional clients. So I still have quite a number of institutional clients, and they read the weekly research, but they get additional service as well. So I have those clients. I have, but because of my introduction on Substack, I've been able to price the product, the pure research product, at a price point that's still approachable for wealth advisors. It's $999 a year or $89 a month. And so I now actually have a number of wealth advisors that are clients as well. And for me, it's interesting. I'll do conference calls with them. And it's really actually helpful to me to hear what individual investors care about, not just what institutional investors care about. Over time, institutional investors have gotten more interested in risk management, and individual investors are still focused on returns. So that's the core product. There's also, for clients that are smaller institutions or hedge funds that still want to pay with commissions, I have an affiliate relationship with a New York-based broker-dealer called Macro Risk Advisors. It's one of my old colleagues at Lehman Brothers, who then went on to run derivative sales at BAML, started the firm. Dean Kernett, he does fascinating work on volatility. So I've gotten back to my old equity derivative roots a little bit with my relationship with Macro Risk Advisors. So that's another way you can access my research and get Dean's as well if you're an institutional client or derivatives client. I do produce a weekly podcast that you can get as a subscriber to my research, and that's Ironsides. That's Ironsides Macro at this point.
I didn't realize that you were pals with Dean. I'm a huge fan of his podcast, and I think actually that's where I found you. I was talking to one of our mutual friends, and I said, we were talking about bonds. And I said, I just listened to this fellow Barry Knapp on Dean's podcast. It was the best interview I've heard in ages. I'd love to chat with him. And he said, I know Barry. And that's how we got introduced. So I owe Dean and my buddy a big thanks for introducing me to you.
Yep. Thank you. No, I appreciate this conversation. It's been fascinating to be entrepreneurial again and start Ironsides Macro and engage with lots of different types of investors and lots of different ways to distribute your work, and no longer work at a quasi-governmental agency like Barclays Bank. No, I love Barclays. I have lots of good friends there still, but it was just it was fascinating to be out on my own now. So,
well, that's great. And you get to do all the backcountry skiing, and we'll talk about that more offline. Barry, thank you so much for being with us today.
Thanks, Kevin.
It's that time of month when Kuppy joins us for Kuppy's Corner. How you doing, bud?
It's been a tough day.
Yeah, what a shit show out there. I mean, listen, let's just start off with talking about it right out of the gate. Like, will things get worse here? Or is it time to just pack it up for the year and just call it a year and or is this going to be a big buy on dip? What's your take on the markets and how this is playing out?
I think it's going to get much worse. I just don't see why anyone shows up on DC3 and, puts money to work. You have a couple things at play, Powell took a transitory at back and shot it in the head.
Killing transitory. It's amazing that they flip-flopped on it like that, right? Like, and that probably means it is transitory, the fact that they've given up on it. But anyway.
3 more days like this and we'll have deflation.
Yeah.
But look, there's a couple things going on, okay? The first one, I put a tweet out about this. I meant to write a thread about it, but then I ended up getting drunk that night and never got around to my blog. That's the beauty of having a free product, unlike your guys. But look, you have a lot of hedgies. Like a lot of my friends had just legendary years, just huge years. And, they all peaked out sometime September, October, they all kind of just peaked out. Small cap stopped working, commodities stopped working, it all stopped working, and they've all given some of it back. And when you're a small hedge fund guy, and I'm not talking about the multi-billion-dollar guys that make do on their 2% management fee, the management fee doesn't really cover what you're doing. Right. That's not where you show up to work. You show up to work for the 20. And so I see my friends, and they're seeing that 20 slip from their hands, and every day they show up to work, and they're, they were owed a couple $1 million, or maybe, big numbers, $5-10 million, and suddenly there's like a little bit less every day, and they're kind of looking at this and they're saying, the hell am I doing? Why don't I just cash it all in and go off on vacation and for 20 days? And so every time we have a day where there's a sell-off, more and more guys are just like, oh shit, I gave back another $1 million today. That's personal money, not like fund money. Yeah. And they're just like, let me just cash it all in. Screw taxes. I'm going on vacation. So that's why these things are kind of feeding on themselves. You get that thing going on, and I'm talking to all my friends. They're all basically saying, "Hey, Kuppy, what are you doing? What I'm hearing this guy's doing this, and maybe I should have sold it 2 days ago." And to be clear, I'm not selling anything. I'm just standing in there like a man and taking the pain. I have massive tolerance for pain, but this is even getting to me.
It's volatile. Well, and you know what? In the pain in the oil market, that's crazy. So let's talk oil here for a second, because like it was really a crowded trade. And I mean, you played oil in a very specific way. You were out on the term structure a little farther out, so you weren't playing the front of the curve where the huge backwardation existed, where where that hammering really happened. But the whole oil curve, even though it was flattening, it did get hit, and so it's just cleaning out everyone that was crowded and leveraged in that oil trade. Just amazing that we wiped out that entire, September, October, November rally in oil in just like 3 days. It was insane.
It was brutal. It was nutty. But look, the reason I played it the way I played it with 25 paper and those 23 call spreads is because, quite honestly, it didn't really hurt me. Oil crapped out, implied vol spiked. My options hardly even went anywhere. I mean, admittedly, they're like 3-bit at 5, so who really knows? But they just didn't go anywhere. I mean, oil for the month dropped from 83, it dropped to 65. It's a pretty big hit, and Lord knows I have enough oil exposure. And my fund was unch on the month. It's just because I went out back and I just thought there'd be low delta, and it did exactly what I thought it would do. In terms of the strategy. Now the curve got very flat. It literally was 2 weeks to flatten the curve. And now that we're nice and flat, I actually put some money to work at the front of the curve too. There's a little bit of backwardation, so I could roll down the curve. And I don't know, I like 65, 66 area. So I put a little bit more on because, you're supposed to buy the dip, right?
Yeah. So some CTAs are being stopped out and other things. I mean, at some stage, it's got to be a buy on dip, at least for a reaction for a trade. But I don't think anything has really changed in the oil story in the bigger picture, other than it was crowded and the margin calls just came whipping out here, right?
Right, and I think when the commitment of traders comes out in a little bit, I think you're going to see that guy. Look, it wasn't a very crowded trade based on CTA. So on the commitment of traders, it wasn't crowded. So it must have all been OTC. But what I think you're going to see, and I wouldn't be surprised at all, is if shorts just lent into it. They just kept leaning into it. And there's a huge build on the short side. I think that's a lot of it. I mean, look, nothing's changed in the news. Biden did his SPR thing, whatever. It's a small number. It's a couple hours of global, usage. The Saudis, they went ahead with the 400,000 raise. It's also kind of a small rounding error of stuff. We had our Omicron, and everyone kind of shrugged. I mean, it's not bad when they couldn't even scare my mom. Normally, my mom calls me up bitching about every new variant. No, she Jewish mother, but she calls up, I love you, mom. I love you, mom. But she calls me up and she's, hey, Harris, have you heard? We got this thing and this thing. We're all stockpiling cat food and we're all gonna die. And it's like, okay, thanks, mom. Like, yeah, I'm triple masking. Yeah, mom. Yeah, mom. And this time she calls me up and she's like, can you believe this inflation? Like, broccoli's doubled in price this year. Like they couldn't distract her from the inflation. They did this hoax variant, and my mom's still fixated on the inflation.
Well, that's the case. Well, listen, let's talk about these gas stocks for a second, because Nat Gas has been pulling back, and finally, Sandridge and Range Resources and these types of Nat Gas stocks have been pulling back. Do you view this as a buy on dip on these things now that they're doing this kind of a pullback?
Well, I wouldn't buy Range Resources with your money. No, look, Sandridge, I think we've talked about this in the show. I'm long some. I sold some calls against it. Turned out to be the right trade. Those guys are selling that gas at a 4 or 5 handle, and the whole balance sheet's cash. It's like a third to half the balance sheet's cash now. They have no debt. Look, it's a cheap security here below 10, but I sold the calls against it. I've sold some on the way up. I like buying these things when everyone hates them. We're kind of in the middle of the move here. It's probably going higher, but I don't feel so strongly that I'd add, because, quite honestly, I was selling on the way up, and I don't feel so strongly that I'm looking to do damn near anything except capture some of that sweet 85 vol. So
yeah, no. That's a pretty rich vol up there. How about your take on these uraniums? Obviously, that's also a very popular trade. And what's your take on this?
So let's go back a second, okay? Because I think you jump in the gun. You have two things that are happening in the markets right now. So everyone's locking in their year. And the other thing you're happening is that you have a lot of funds that own the same 50 stocks, okay? Every hedge fund has just been piling into the same 50 names. It's the SaaS compounders. It's the compounder bros. And they get more inflows. They buy more of it. They get more inflows. And, it's so far past the point of caring about the valuation. Once it gets past 10 times revenue, do you care if you pay 40 versus 60 times revenue? It doesn't really matter. It's, especially just up to the right. And so you had this company Docu that warned today. They missed. That was last night. They missed by a penny sort of thing. It's a little more than that, but whatever. And they clobbered the thing. It's down 40%. And it turns out it's the biggest hedge fund hotel of all of them. And I think it's setting off margin calls and liquidations all over the place. Some of these stocks have been leaking for a while. The ARC names have been leaking for a while, the Teladocs of the world and all the other things that are Ponzi. But now you're getting to the stuff that's not quite Ponzi. There's actually profits here. It's just 200 times profits, And so this stuff's starting to get liquidated. And these hedge funds, as you know, hedge funds like to do, they take a good idea and then they keep doing it. They keep doing it and they add leverage to it. And then it always blows up. And, it's just I bet you everyone in Manhattan is along the same 50 stocks. And they're all calling each other up and saying, what's going on? What's going on is they're all selling. They're all having a margin call. And so I think it's going to keep going for quite a while because, when you go from a growth stock and it kind of goes no bid, you need it to drop to a price where guys like me show up. I'm a curmudgeon value guy, and I'm not buying it at 40 times revenue down from 60 times revenue. I kind of want to pay 7 times cash flow.
Well, that makes sense. So you were mentioning ARC there. Do you think? I guess this is the end of the Ponzi trade for you, isn't it? Is this where? Obviously you think it's going to keep going. What do you make of what's happening with ARC and all these crypto ETFs and everything?
Well, the whole Ponzi sector is blowing up, and the same, crypto bros own the ARC names. It's all Crust-owned, okay? So, you'll have, sophisticated, well-respected hedge funds in New York that have billions and billions of dollars of this crap, and they don't own, Tesla. They're probably short Tesla. But, they own all the other stuff she owns. And so when a little bit of the neighborhood gets torched, it's this, forest fire just burns through the whole neighborhood. And I think that's what you're starting to see happen with uranium and with oil. oil was a crowded trade. People were talking about it. The smart guys owned it. Uranium also, the smart guys own it, and the wise guys own it. And it's why you see the Sprott vehicle trading to the biggest discount to NAV since the ATM started. This is because guys just need liquidity and they just need to hit bids. And so they're just hitting bids. And, I think it's going to get worse before it gets better on a lot of these products. But it's all kind of tied together. It's kind of funny because when I look at my screen at the stuff that I own that's up on the day, and I actually have a lot of stuff that's up on the day, it's the stuff that no one's really talking about on Twitter. It's the stuff that, most people don't even know I own. And then you see some of this other stuff and it's just getting roasted.
Yeah. That's crazy. Well, listen, I want to wrap things up, circling to one. Like you've told me for over the last year or two, as you've been coming on for Kuppy's Corners, not to mention Yak, your Mongolian growth group. And what the hell's going on here, Kupp? Because finally, after a decade of this thing being in the gutter, it's suddenly moving. Is something going on here? What's going on?
Well, something is going on. I haven't really wanted to talk about it because honestly, the story was just pretty embarrassing and depressing. We started a company a decade ago now. I can't believe it's 2011, but we started a company to invest in Mongolian real estate. And about a year after we started the company, Mongolia went from the fastest growing economy on this earth to a 10-year self-inflicted depression. It's been the worst economic depression. I mean, I think we could have bought like Afghanistan or Syria and done better. So in any case, we still believe in Mongolia. We still have some properties there. We still have a team there. The team's doing an amazing job under impossible circumstances. But we've sold some non-core assets over the last few years, and we started investing, and we invested in public securities, and we've done surprisingly well. And we've invested it in, Kedem is owned in there, and Kedem's been very successful. And, we had to put up some money early on to pay for the people that are producing Kedem. And so, it's a business now that has a go-forward life. Kedem keeps the lights on, more or less. And we have a pool of cash and marketable securities. And my goal with this is to turn it into a vehicle that we can use. They call it a merchant bank, I guess, but I'm not big on, descriptive nouns and adjectives. But we're going to use it as a vehicle to buy, control stakes in somewhat, public and private companies, somewhat of liquid stuff, the stuff that I can't touch with my hedge fund because I have monthly liquidity. And, hopefully we can exert influence in a positive way at these companies and create a lot of value. Me, who knows about me, but I think the other guys on my team are pretty sharp. And, we've been literally chasing around in circles, trying not to go broke for a decade. And it's great to finally have liquidity and be able to think on our feet and hopefully create some value going forward, as opposed to just, trying to, kite checks around and basically make payroll. So, the stock's going up because the situation's gotten better, the liquidity's gotten better. And in my Q3 shareholder letter, for the first time in a very long time, I had some upbeat things to say because things are getting better. And I think this company's going to eventually have a future. And I think the shares are, at least someone read that letter. I guess a final point, I own a quarter of the shares. I'm the chairman and CEO. I got to be careful about what I say about the company, but between myself, Jen, our CFO, our board, we own about 30% of this thing. Insiders own it. You can look at the insider filings. We've bought a whole lot of stock over the years because we believed in ourselves even when no one else did. And the company's bought back a lot of stock too. We bought back about 20% of the shares outstanding. Really, when we had no working capital to make payroll, we still hit the bid on the buyback. So now that we have some flexibility and liquidity, I'm hopeful we could do something really smart with it. And so anyway, that's what's happening at Yak. I own a bunch. You guys should own some too if you don't. And if it goes all wrong, don't blame me. It's a Mongolian company. You should have known better.
Oh, there you go. All right. Well, Kupp, before I let you go, though, you write that amazing event-driven monitor there, the Kedem, that is now revealed to be owned by Yak. But
I don't think it was a great secret. It's been in the disclaimer for a year.
Yeah. Well, at least I didn't know. Anyway, but where can they find you and follow your stuff? Because it's a pretty awesome read every week. I love it.
Hey, thanks. Go to kedm.com. We have a free trial going. If you haven't taken a trial and signed up, take it for a test drive. It's not very expensive for what you get, and hopefully we can help you flag some great trading opportunities. I know it's helped me flag so much stuff. I mean, I've had 2 just legendary years back to back, and a lot of it is just flagging unique opportunities that the guys at Kedem found for me. So I'm a huge fan of the product, and I also write the commentary sometimes.
That's awesome. All right. Well, listen, I wish you luck in surviving this carnage that's coming in the year end. And thanks for joining us, bud. And we'll have you back on in the new year.
Yeah, sounds good, man. Just avoid high ledges.
All right, Patrick, it's time for Talking Charts. What do you have in plan for us?
Well, listen, we just got to get to talking about those top 3 things we were watching last week. And so let's just quickly go. We were watching the dollar, not much happening there. But number 2 was Fed Chair Powell testifying. And did we, was that a surprise?
The only mistake we made was not making it number 1.
Exactly.
Yeah.
I was shocked with the headline.
Well, what was shocking to me was if you read his release testimony on the night before, it actually read very dovish. And if you go through it, it seemed like he was once again hitting pause because of the Omicron variant. And then all of a sudden, he goes in front of the Senate Banking Committee and he just unleashes a bomb.
Yeah.
And it's just next thing you know, it's collapsing, and he's in essence guided towards accelerated taper.
Yep. It was quite the surprise, and we were watching that. But the number one thing we were watching was are the variant fears overblown? And irrespective of whether they are overblown or not, the market certainly has not rebounded on that. And we'll talk a little bit more about that. But clearly, what the variant was used as the rationale for the sell cycle that started, and we continue to see the markets under pressure here, right?
Yeah, and whether it was Powell or variant or something completely different, just a function of positioning, which is what I believe. We're definitely in correction territory. All right, so what are we watching next week, Patrick?
All right, so we have to watch whether that risk-off trade continues next week. We went down on the S&P towards 4,500, which is a 50% retrace of the prior rise. And after a 250 point drop, 5% drop, typically if it was just a market correction, this is a point where typically the buyers would come in and buy the dip. And so far, every single intraday rally has been immediately hammered, and the selling is continuing. And with us right now at these kind of critical levels, it's the single most important thing to watch next week is whether or not the feet of the market get kicked out from underneath it, and we have ourselves a little bit of accelerated selling. Any insights as to what you think is going to play
out? I guess
out?
to me, one of the most shocking elements of this week's route is how the VIX is being bid. Mm-hmm. It just refuses to come in. And I thought today with the getting the unemployment number behind us that we would have a collapse in a collapse in VIX, and it didn't happen. Maybe a little at the end, but it was extraordinarily well bid, and I think it's helped driving this market lower.
We continue to be right. We saw a print up to 35 on the upside, and still in the 30 handle on the VIX into the close.
It feels to me like somebody's offside. It just felt like there's somebody needs to get it in.
Yeah, it's the question is there a catalyst that could really spark that Christmas rally here? Anyway,
one of the nice things about this, Patrick, is that because we have the VIX here, if we were to get a situation where things calm down, we would have a monster Vanna bid.
Oh, absolutely.
And Jem Carson just keeps going on about it. He's tweeting Vanna doing push-ups every single day. And if we get it, that it could feed on itself.
Yeah, I mean that is probably the single biggest thing that's on the sideline. Because we have a market that's corrected more than sufficient on the downside, and arguably with the VIX already up at this level. Actually, Brent Kachuba had a great piece out a couple days ago where he was showing the distribution of what happens after the VIX has a move up into the 30s. And it shows that obviously there's a number of the tail risk events that can be spurred, but more often than not, the rally that ensues on the other side is huge. And so one way or another, big volatility next week is likely, whether it's a rapid acceleration on the downside or one of those violent Vanna rallies. Strap on your seatbelts. It's going to be an interesting ride next week. Anyway, so moving on to number 2 is the short-term bottom on oil in. And oil just continued getting hammered until it put in that low yesterday, down around it was about $62 just on the 62 handle. But we were right back down to those July and August lows, and it was just amazing to see how crude oil wiped out basically $15 to $20 in a span of days.
That's fast. It's just a function of this new market, right? That we get this over and over again. We get people, a theme that grabs everyone's attention just when everyone's sure that it's for sure going to work and everyone's all in bullish. It's just a rug pull.
And what's interesting is that Kuppy was talking about the fact that the commitment of trader reports weren't totally overly bullish. But yet, when you think about the sentiment toward oil, it was really hard a month ago to find anyone that had a bearish tilt on oil. Were there people?
Yeah, I'll take the other side of. I wasn't able to be on the call with you and Kuppy, but I'll take the other side of Kuppy's trade there. Although maybe the commitment of traders was not reading bullish, I think that's because it's distorted by the fact that I think China is labeled as a speculator. And I think there's large players that just cause the commitments of traders on oil to be all messed up. I don't think you can look at it. And tell me somebody that was bearish on oil. Yes, there might have been one or two, but on the whole, everyone was just all in.
And the ones that were leveraged to the tilt.
Yeah.
And so the margin calls just kicked in, right? But with this magnitude of a wipeout, a reaction to the upside was given. And this is how you won your little bet. Which will settle up here in a little bit. But the violent whips the other way are normal when you have this magnitude of selling.
Yes.
But the bigger question is there some sort of a tradable low that was just put in this week?
And well, now that you wrote that, it's for sure not going to happen.
You know what? I actually think whether it ends up being the low of this sequence is different. I'm talking about a tradable low, which is that there's an opportunity. Think about it. Already off the low was a $7 rise.
Yes,
right?
The volatility is large. And one of the things that I would like to highlight is if you pull up the volatility on oil itself, it's quite high, and it's pretty tempting if you were to wanting to get long to do some selling of some puts. Do it in a responsible manner. You don't want to be irresponsible.
Yeah, to be creative. But how do you put it on?
Yeah, you can sell put spreads. You can limit it. But I definitely think that there's something to be said about selling that vol. It's apart from the negative price vol debacle, which I think you almost just have to take off the sheets and not even look at because that's kind of dumb. And who knows how you price volatility when you let it go to a negative. But apart from that, we're at the levels that has traditionally been sell points in the past for crude oil volatility.
Yeah. So, and the number one thing to watch is those inflation numbers. Next week, we're going to get CPI. Look, I'm not trying to call that there's going to be a massive drop in inflation, but the thing is, it's really hard for those inflation numbers to keep that rate of change up in such a increasing manner. And as soon as the market starts to sniff that the upside momentum of inflation is running out of steam, there could be a whole whack of macro traders that start using that as a signal to fade the other way. Do you think that this still comes in hot? I mean, these commodities are already off their highs. What's your feeling about inflation?
Well, you have to be careful because it's what's priced into the market versus whether it's up or down. It could very well be down. I'm not sure what's priced in, but my point is I think that inflation numbers will continue to surprise on the upside, not the downside.
On the upside?
Yep. Versus
Really?
expectations. I suspect that you'll find that just somehow there'll be something that'll just be, it didn't expect that, and all of a sudden there'll be higher inflation.
Yeah. I'm not going to drink your Kool-Aid, buddy.
I know you don't like the inflation Kool-Aid. You're too busy going and hanging out with Gary Schilling and having his Kool-Aid.
No. Look, I'll tell you. You've been right along the way because, listen, I remember in 2018 when you were saying that this was inevitably going to come. Just because you're 2 years early doesn't mean you weren't going to be right. Like, you're like a broken clock. You're going to eventually be right if you keep saying the same story. Well, with that said,
Patrick, I would change my tune if I didn't believe that if I thought we were getting truly contractionary fiscal policy. But I just don't think we're getting it, and I think that we're going to be surprised. Anyway, that's what makes a market.
While I'm not in the camp that there's imminent kind of going to be signs of imminent deflation or something crazy like that, but I think that the rate of change on the upside is totally going to stall out. I think that we're going to see the inflation numbers coming in flat from month over month or even slightly downwards, but still stay elevated.
I'm trying to figure out, do you know how to get somewhere what the number is expected?
Yeah.
Like the forecasted number?
Yeah, I'll take a look right now.
Forecasted inflation, because I'm not following close enough to know what it actually should be.
So on the CPI, let's see here, the forecast is 0.7. And the previous one was 0.9. So already the expectation is that for it to
right. So that's my point. Is I think it beats the lowered expectation.
All right, that's interesting.
Yeah. So you know what?
I think
might have the makings of a wager for next week. Let's just go on to the next point.
All right. So there is no next point. Let's talk some charts. Just want to talk about some of these things. So like the S&P 500, you wrote an interesting macro tourist piece. I don't often read your stuff, but sometimes
I'm honored you got this one.
Sometimes
did the picture interest you? Is that what?
Yeah. No, absolutely. Yeah, absolutely. Your picture is always I always look at the picture and then
you always look at the picture, but this one you actually read the article.
Really because actually it was something that I was talking about for over a week or two, and I just wanted to see which angle.
You're always ahead of me, buddy.
No, I'm not. But the thing is that the market breadth was something that was red flagging for me already several weeks, and you just really highlighted. I have a couple of charts that kind of not the same ones you use, but what's interesting is so S&P is 5-6 days into a sell-off that's 5% off the highs, and a couple hundred points off there. And yet, when you look at something like the percentage of stocks that are on the New York Stock Exchange that are trading above their 50-day moving averages, we hit under 25%. We were down to like 22%. That's the lowest level that we traded in like almost 3 years outside of the coronavirus crash. We are seeing such broad deterioration of market breadth, and yet the S&P is just 5 days off of its high and 5% off its high. Yet these kind of indicators are typically already so oversold that this is a zone that would typically be bought.
Well, that was the point of my piece. I called it pain beneath the surface, because if you take away those 6 stocks that have just been holding up the whole market, and in fact, if you looked at Apple, for example, this week, it was crazy. We had the S&P going out at the lows of the day, and we had Apple going out at the highs.
Yeah.
It was absolutely insane. But my point is that if you took out those 6 stocks and you looked at the rest of the market, we're full blown in a major correction, and there is a lot of pain out there that people aren't.
Small caps gave the entire breakout back. Like it's.
Oh, by the way, somebody was highlighting on Twitter that we failed to recognize that the IWM did the classic and most perfect prairie dog that has ever been. And
it did. It was a prairie dog. It is, but to me, to me, a prairie dog is more of like an intraday or a one-day pop. Like when something can sustain for days and weeks.
Well, let's go to the charts. Let me see it. Okay, we'll make a judgment.
Well, I just wanted to just touch on Apple here. No, because you highlight Apple. We'll just go in order so you can see. Like just a couple of days ago, Apple's like hitting 170 on the upside.
Yeah, and it was a month ago. It was 150. It tacked on $20 in the midst of a decline in the stock market.
Yeah,
and that's the world's biggest stock.
Yeah, and it is. It's in such a huge market cap behemoth. But so here's the small caps, right? And so they did break out in October, and when they broke out, they spent like 2-3 weeks, almost a month, trading at higher highs. So yeah, it does. I get the idea.
I think it's a prairie dog because the reason I think it's a prairie dog is because the range that it went sideways on was so long. So therefore, a prairie dog can't just be a day on this. It was a year it went sideways.
Yeah.
And so the fact that for a week it went higher, that's a prairie dog. I'm calling it a prairie dog. It's officially a prairie dog.
You know what? Listen, I'll let you have this one. I don't think that this is where I want to.
And then not only that, do you see how it gapped down through back into the range?
Yeah.
And now it's just that's an ugly looking chart, man.
But
kind of gets me excited because it's so ugly looking.
But what's interesting is how almost anything and everything that has not been working just continued to sell. So like whether you talk about those Chinese internet stocks, breaking fresh new lows, or whether the cannabis stocks, or even gold miners and everything, it doesn't, like, first of all, the shit that's been sucking all year just continued to suck right into the end of the year. Like I guess the tax loss selling story really it adds only additional fuel to that storyline, but so weak. But what is interesting, and I want to go back to this FANGs thing you talked, because there was Apple, but when you started looking at some of the other FANGs, they're starting to break. Look at the way Facebook rolled right over and broke to a fresh multi-month low on the downside.
Yeah, this last week. You're right. This last week.
A few of these, like Amazon. Look at the way Amazon is giving back all of that bull breakout it had a couple weeks ago. It's not really an ugly breakdown yet, but the FANGs are finally starting to take a little bit of a sting here, and it's really starting
think that
to
maybe Apple will be the last one, and that'll be when it's all over. Or do you think that'll be the end of the correction, or do you think that'll be the start of when it gets really ugly?
Well, I'll tell you right now, that's why we have that in the things to watch, right? Because if we see the S&P give out 4,500, it's coming on the back of Apple breaking, and that's that. If we're going to have a downdraft down to like 43 or 4,100 on the downside, that it's going to happen with Apple participating. The likelihood that Apple,
because it's such a large portion, and if they hammer the one last value name in terms of quote unquote value. It's not really value, but
the last place to hide.
The last place to hide, yeah. That'll be it.
Well, that could lead to that true kind of capitulation puke point that really puts in that short-term low. But you know what? Who didn't get the memo? Lumber didn't get the memo. Did you look at the way lumber's been ripping?
Huge alpha trading that.
Yeah, but it's just so many commodities are getting hammered, but not lumber.
It's negatively correlated with the market.
Yeah,
Are you going to talk about like all the meme stocks and those things?
Oh, we can if you want, but I wanted to just before we go there, I wanted to just touch on nat gas. And nat gas did a little pop and drop last week, and was really sold off pretty hard here. And it's really interesting in my mind to see whether or not, as we kind of get to this $4 level, whether this is just going to be a buy on dip here on nat gas. Because if we are sort of in that position where crude oil is also near a buy on dip along the bottom, and this pretty oversold. This has been a 4-day ugly sell-off in the gas. Like I don't know if you still have any of that.
No, I remember I sold most of it, and all the front end, and I have some long dated contracts, but that are far out there because they're a little like the Hotel California. When you check in, getting out of them is a little you're not really allowed.
But you know what? I want to entertain the idea of buying the dip here.
Well, you know what? You're getting me excited because I haven't really been full on a nat gas bull in a long time, and now I'm looking at this chart and looking at that pain and thinking that I still have a few fingers left, and it might be time for some knife catching.
Yeah, I think knife catching the gas contract is something with
the nat gas bulls. We're sorry when it keeps collapsing and goes to new lows. You can blame us.
Because when me and you agree,
that's right. We're done. There's not a chance that trade's going to work, folks.
All right. Well, last thing. Let's do a shout out to Kathy Wood and ARC.
Yeah, the pain in this square, in the whole meme stocks. There's so many of them now that are just getting crushed, and Kathy's names are getting destroyed. I feel bad for this young group of retail traders that have bought into this narrative, and they bought a lot of shitty stocks, and apes aren't leaving or whatever. And I don't know if you're aware of this, Patrick, but a lot of them, when they're talking on Reddit, they talk about how one of their lines they like to use is you're going to make so much money, you're going to be able to get rid of your wife's boyfriend and get him out of the house. Which I think is just hilarious. And like my son told me that, and I was like, really? And he said, yeah, it's a huge thing. You're going to make so much money. You can get rid of your wife's boyfriend, get him out of the house. Well, I think the wife's boyfriend might be staying a little bit longer with the action in these stocks lately.
All right. Anyway, that's enough for talking charts. Let's go on.
All right, Patrick, it's time for This Week in Trading History. What do you have planned for us?
So we're going back to December 1st, 1913, the launch of the Ford Model T assembly line. So the creation of the assembly line by Henry Ford at his Highland Park plant, introduced on December 1st, 1913, revolutionized the automobile industry and the concept of manufacturing worldwide. So Henry Ford had a goal of making automobiles for the masses. The Model T was his answer to that dream. He wanted them to both be sturdy and cheap. In an effort to make the Model T's cheap, he first cut out all the bells and whistles. The buyers couldn't even choose the color of the car, which was only offered in black. The cost of the first Model T was set at $850, which would be approximately about $21,000 in today's currency.
Can I interrupt here? Because wasn't he the one who said customers can have any color they want as long as it's black?
Yeah, that's the one.
Yeah.
and he goes, but while that was cheap, it's still not cheap enough for the masses. So Ford needed to find a way to cut the prices down even further. So in his ambition started a few years earlier in 1910 with the aim of increasing the manufacturing capacity for these Model Ts. And so Ford built a new plant in Highland Park, Michigan, and he created a building that would be easily expanded with new methods of production and that were incorporated. One of the first innovations in the production that Ford implemented was the installation of gravity slides, and that facilitated the movement of parts from one working area to the next. Within the next 3 years, additional innovative techniques were incorporated, and it was on December 1st, this week in history, back in 1913, that the first large-scale assembly line was officially in working order. In total, The manufacturing of the car could be broken down into 84 steps. The chassis of the car were pulled down a 150-foot line by chain conveyors, and then 140 workers applied their assigned parts to the chassis. Other workers brought additional parts to assemblies to keep them stocked. This reduced the amount of time the workers spent away from their stations to retrieve parts. The immediate impact was the assembly line was revolutionary. They used the use of interchangeable parts allowed the continuous workflow and more time on task by laborers. Workers' specialization resulted in less waste and higher quality of the end product. The sheer production of the Model T dramatically increased. The production time for a single car dropped, get this, from 12 hours to just 93 minutes. Due to the introduction of the assembly line. So Ford's 1914 production rate of 308,000 cars eclipsed the number of cars produced by all other automobile manufacturers combined at the time. So these concepts allowed Ford to increase the profit margins, lower their costs of the vehicles to the consumers, and they got the car down to eventually drop it down to $260 by 1924, the equivalent of about $3,500 today. So it's revolutionized assembly line and was a great story.
Okay, Patrick, time for skin in the game, and I actually won one.
You got me. Well, you know what?
And this was moose steaks. This was big time important one.
It was. You know what? You want a proper moose steak.
Yeah. And everyone was talking about the fact that it was a record win in terms of timing.
Listen, I actually was trying to trap you. I
know you were.
Before, like when we were doing talking charts, you were so sure oil was going to go lower.
But having said that, not only that,
you were right on both ends.
I know.
Were right on both ends. You were right that it went lower, and then you still clipped me on the retrace. I put the 72 right in the fib retracement zone of a little snapback rally. I was like, I'm going to clip them, and you got me. You got me.
It was funny. Okay, so let me just. Sorry, I'm not ready for this. You got me laughing so hard. Okay, Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, a case of beer, 2-4, bottle of wine with a $100 limit, and the ultimate, the steak dinner. Although I feel like a moose steak dinner is even better than a steak dinner, but that's up for debate. The winner of the bet is obligated to create a new bet for the following week, so that falls to me, and all wagers settle in full, and there will be no netting in positions. So, Patrick, I want to do inflation.
All right.
Where did you find that expectation for next week?
So I was just looking at the Forex factory here. Let me pull it up.
So this is what we're going to do. I don't actually know it, and I'm not in front of my Bloomberg. But after I do this, I'm going to go log into.
So right here.
Oh, have they got? But how many? Where is the expectation coming from?
Right here, 0.7. Well,
yeah, but what we're going to do is we're going to go because Bloomberg highlights all the different ones. So I'm going to figure out the official. Official expectation.
We're just doing over under on the official expectation.
That's correct.
All right.
And so you get to choose. So I'm hoping.
So what happens if it's what if it's a direct hit?
Direct hit.
Well, because we're doing an over under. So is it over under? Like if it's a point, if it's a 0.7, who does it go to?
Aren't there more digits that we just don't see? I think there's more digits that we don't see. But if there's no so this is what we'll do. If it's a direct hit, we'll both give money to charity.
Oh my God, that's no.
Whoa. Okay, Lena, bleep that out. Okay, so what do you want to do then, buddy? Okay, look, I'll tell you this then.
All right.
Equal or above. Okay, so let's just think this through. I think it's going higher. So you can choose equal or below. I'll give you the equal.
All right. I'm going to take the equal and below.
Okay. And what do you want to do? We got to tone it down. We had like 3 steak dinners in a row.
Yeah. I don't think we have to do
were
anything
just
crazy.
It was
like
getting
that.
crazy. So
No, let's do a picture for the piss
okay, picture it is. A picture it is.
All right.
Okay.
So it's time for no stupid questions, just stupid answers. So let's get started.
Let's get the real start of the show on here.
All right, Lena.
Okay, first question. Love the podcast. I'm writing this as a wallow in my gold and gold miner leaps that keep falling out of my pockets as I buy more on the dip. Eric Townsend talks about inflation and Jeff Snyder talks about deflation. They say that gold is a safe haven when the stock market gets wobbly. I'll believe it when I see it. If 2022 is inflationary or deflationary or a period of stock market drawdown, wouldn't gold and gold miners be a great 2022 sector? Anything to help me hold on to my conviction in this tax loss hell we call fall. Thanks.
So who is this Eric Townsend guy?
I don't know. It's
And Jeff I do agree that that's the one thing you got to learn about the Doom podcasts and websites is that no matter what, gold is a buy. Although whether deflation, inflation, it's a buy. There's always something negative out
Look
there.
at you, like says the guy that's loaded up on gold.
I know.
And
to be fair, they're not always that bullish anymore. They've now replaced it with Bitcoin, but even that, I suspect now that it's not behaving so well, maybe they'll start to not be as excited about that. Okay, so what's the question here? Any help to help me to hold on to my conviction in this tax loss hell? I will give you some help. Obviously, you should do what's right for you. If you're not comfortable with the risk, you should do it. You should go consult an investment professional. I'm going to tell you what I'm doing. I am still long some of my long-dated leaps, and I bought long-dated leaps in gold and silver. And one of the reasons that I was attracted to it was that it gave me the opportunity and the ability to sit through a lot of this pain because they're so long-dated. There's a lot of time value working my way. The other thing that sorry, go ahead, Patrick.
Yeah, I was going to just say one of the other things is that, like we were talking about in last week's show, there's a lot of the market is now priced in way too high interest rate expectations.
Yes, and that's part of the reason that we've had such a terrible time in gold is that nominal rates at the short end at least have priced much higher. The other thing I like about owning the long-dated leaps is that I do it and I sell even higher strike calls against my calls. And the nice thing is there's a big, huge skew. Usually as you go outside and you go more and more out of the money, you'll find that they're worth less and less. Like if you look at the S&P, the skew is definitely a kind of a smirk, an Elvis smile, an Elvis Presley smile. But in gold and silver, it's the other way around. It's a full-on regular smile, because I believe it's curved on both sides, right? Yeah, it's curved on both sides. And so what that means is that you might buy 10% out of the money leaps for, I don't know, 35, and then you can sell 35% out of the money calls for 50, and so you have the skew working in your favor. So those are. I still own those, and those are still something that I love. I'm not going to get rid of them yet, although it is hurting. I completely agree. It has been a disappointment.
Yeah, well, I mean, we also talked about the fact that the tax loss window is closed.
Well, so now what I was going to say is on the tax loss side of it, we're not there yet, but we're really close.
Yeah.
And I don't know exactly when I'm going to get long. I have a couple of studies that I'm working on, and I'm going to have some specific dates. But I'm hitting the point where sometime in the next couple of weeks, I'm going to get full on, bullish on junior gold miners, and I think that's the way to play it for me, at least. Right. So again, you do your own homework. We're not giving advice. For me, I'm sticking with my long dated leaps because that's part of the reason I love them is that it enables me to sit through these sorts of things. And from a trading and a tactical point of view, I'm going to be looking in the next week or two of getting really long the junior gold miners.
There you go. All right, let's do the next one, Lena.
Second question. What actually gives the VXX its value? And why would 3 or 6 month call options on the VXX even go up when everyone knows these vol spikes only last a week and come back down? Is buying the VXX just some game everyone plays where we silently agree on the rules? Or are institutions able to arb this for value? Thanks. Go Canucks.
There you go.
Do you want me to do this one, Patrick?
Yeah, go for it.
So the VXX, it is a complicated instrument in that what they own is futures that expire into the cash value of VIX. So it's like betting on the price of options that are, in essence, bets on the price of an underlying. There's it's many layers.
Yeah.
And in terms of why does anyone ever buy these? Because when it only goes up for a week and then comes back down, yeah, you're correct that is often what it occurs. But go dial 2008. Go look at what a real crisis when that happens, how much this thing goes up. Or even Patrick, can we pull up a chart? Even pull up the COVID crisis. It wasn't just a week; it was a long time. And so the reason that people continually do this is because it is a natural hedge against the other risk assets in your portfolio. Now, the real question ends up being, if you are long risk assets and long VIX over time, is it a negative? And how do you ratio it, and how does that work? It ends up being difficult. I do know that there's a few funds that will go and they will use options on the VIX, not VXX, but options on the VIX as a way to express or to hedge that risk. And there's the famous Mr. 50 Cent. Yeah. This option trader comes in and he or she buys options that are at a price of around 50 cents, and they buy 10,000 or 100,000 a crack. I can't remember, but it's big things. Most market players know who that is, and it's generally regarded as a very savvy, sophisticated player that will use it to hedge. And what they do is they choose opportune moments to hedge their long risk book in other ways. But anyways, can I see, Patrick, the 2020 or the spike higher? Yeah. So during COVID, what did it go from?
It went from 55 to 370.
Yeah.
Or 310.
So that is in essence why people continually buy these lottery tickets, because there are those crazy events when it really does go like that.
What's one of the cool things of like you were just talking about your long option positioning on gold because of the right tail skew. But if there's ever a skew to the right tail is on VIX calls.
Yes, but I would almost argue that skew is cheaper than it should be, because that's when you actually really want it.
Yeah, but
right?
But what it does, though, is it allows you to do lots of these different option combination trades where you could buy VIX upside for in debit spreads in some really interesting ways. Obviously, I understand that you want that blowout right tail kind of gamma if you really wanted to hedge a portfolio. But if you're just betting on a vol spike, there's lots of really cheap ways to buy some of that upside.
I will say this, Patrick. 99% of the people that trade VIX shouldn't.
Agree, because it's a complex process.
And I might be underestimating that amount. It might be even higher. Okay, let's go to the next question.
Hey guys, I'm a derivatives trader from India. Love the discussions, the beers, and the humor that comes along. My question is about yield spreads. The 2s, 10s, and 530 spreads, for example. What is the significance of the spread, and how do traders read the spread if it goes down or goes up, assuming it is positive? Are the yield spread traded as well? Also, how are the yield spread used as a macro indicator? On a side note, if Patrick is the Lord of Crayons, I am certainly a disciple.
There we go. One of your crew, Patrick. One of your crew.
There you go.
So
There you
I
go.
guess I'm going to do this one. So the yield curve spreads, what it is it represents the difference between different tenors of bonds. So if you take the two-year bond and it's yielding 1% and the 10-year bond is yielding 3%, the 2-10 spread would be 2%, meaning it's the difference between 3 and 1. What it indicates is the market's expectations about future inflation and also term premium. There's a lot of there's a couple of different theories and many different aspects to it, but in essence, it's kind of a combination of the market's expectations about future rates and also how the Fed is guiding and a wide variety of different factors. The reason that people love to watch it is that when the yield curve inverts, it has been one of the most reliable indications of a recession that we've ever seen. So whether the nuances of every little squiggle matter and actually mean as much to the economy or the markets is up for some debate. But what's not up for debate is the fact that it is one of the few market tools that is just being spot on correct.
And it indicates policy error and just that.
Yeah. So, for example, right now, the yield curve is flattening. The reason the yield curve is flattening is the market is interpreting this to mean that the Fed is getting on the margin relatively more hawkish than they had previously been, and they expect the economy to slow down. And the reason that you can say they expect the economy to slow down is because they're actually buying long-dated bonds at a yield that is coming down. They're buying those bonds, causing them to go up in price. And if they thought that the economy was going to continue and we were going to get more inflation, then they would be selling those. And so one of the things you always need to remember is that if you think about a sovereign long bond investor, if we assume that there's no such risk as default, because a lot of countries there shouldn't be because the currency is denominated in the currency they print. So therefore, there should be no worry about default. So what is the risk? The risk is that they get inflated away. So when you get more inflation, bonds go down, long bonds should go down. And when you get less inflation, long bonds should go up. So ironically, even though a lot of people say, oh, the Fed's raising rates, that means the bonds should go down, it's actually the opposite. Because when the Fed's raising rates, what it's showing is that the Fed isn't going to tolerate high inflation. And therefore, what you're going to see is that long bond investors become more comfortable with owning long duration assets. Obviously, much more complicated than that. There's much, much more, and there's nuances, and it depends on what's priced in. But in essence, that's what's going on.
There you go. Agreed. All right. Let's move on. Lena, where can they submit their questions?
So if you have any questions for Kevin or Patrick, please submit your questions to nostupidquestions@markethuddle.com.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're there on Twitter every day. Lena's out shilling our merch and everything. She loves chatting with all of you. She loves the pictures. Big shout out, Lena. Do we know who gave us the picture of the groundhog with the eagle?
You mean the prairie dog, the ninja prairie dog with the eagle?
Yeah, prairie
that
dog.
Was our listener, Philip. Thank you so much.
Okay. Thank you. And we love it. We love the prairie dog. It's a very noble animal. Listen, you can listen to the Market Huddle.
Especially when it knows ninja shit.
That's right. For those who don't know, go Google. I think that was
I will include it in the YouTube description, actual link to the article that he's referring to.
But am I right that it was a National Geographic top funny animal picture this year?
Oh, I don't know.
I think I clipped it from my database of my pictures, and I believe that's where I found it as well.
It's very
But we
possible.
love it. Make sure you keep them coming. Please send us side effects as well. I'm running out of side effects. I always love to hear more of them. Anyways, you can listen to the Market on all the networks, Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube, as Lena was talking about, to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, or find me at bigpicturetrading.com. And Kev, where can they find you?
I'm on Twitter at Kevin Muir. You can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Okay.
All right.
So, before we get to anything, we need to discuss something very important.
Okay.
Uh-oh.
Kevin.
Sounds serious.
I'm scared.
Did you hear that Lindsay Lohan is now engaged?
I know. My heart fell. But listen, there's hope. And I'll tell you why there's hope. She's getting married to a Credit Suisse guy.
Oh.
I think I can take him. If it was like
we won't tell Mrs. Macro Tourist. That's what you're saying.
If it was a Goldman or a JP Morgan guy, I'd be like, I'm out of the hunt. Like, that's it. I'm done. But it's Credit Suisse. I think I'm good. I think I'm still in the hunt.
All right. Just wanted to make sure you
Yeah, I
knew
know.
that.
I was very upset about it. Very. All I can say is thank God you guys got me my gift. She's not gonna be able to do that anymore. Actually, I got some good stories since then. By the way, since all that I.
Well, let's rate this beer though before.
But
we go.
one second, I cannot share them. They will be piss up stories because I cannot share them.
So you got to be there.
Yeah, you got to be there.
Whenever that may be.
Because I have subsequently heard some good stories of people that have met Lindsay in real life. And let's just say none of the stories have made me any less
Of a fan?
of a fan.
We'll just
Okay,
leave it at that for
Patrick,
tonight.
what do you think of this beer?
All right. It's interesting. So we had a listener that delivered it from St. Petersburg to
That's a
be
heck
featured
of
on
a
the show.
commute.
It is, and but it's awesome. It's actually it's a Mexican style beer with it's when you mix the lime juice, tomato juice, and all the seasoning with the beer. It's like a Bloody Mary beer. It's and it's awesome. Yeah.
Yeah, micheladas are delicious.
Yeah.
That's what the
Yeah.
style of
God,
beer
I'm
is.
glad I'm not there.
Oh, no,
Yeah,
it's so good.
You think?
Oh, yeah.
Yeah.
Well,
Oh,
can
no,
you bring me
it's-
home one?
They only brought me one.
Enough for him to drink during the recording.
Yeah, exactly.
You know what?
Actually,
That's
let's
not true. They really brought enough, but they're all gone, aren't they?
Exactly. I was about to say
One
the
way or
six
another,
pack.
they are
The
all
six
gone.
pack's been demoed.
They are all gone.
Okay, so what's the rating?
You know what? I'm gonna give it an 8.2. It's
Nice. Solid.
It's a solid beer. It's
And so Patrick makes the next step to vampirism. It's a Canadian vampire. We mix our blood with beer, and it's very fitting. It comes from Russia.
yeah.
Russians. I love them. They are tough. Listen. When it comes to like Canadians, we're tough. We play hockey. We're not ones to wimp out. Russians, every bit as tough. They might be even tougher.
Oh my gosh! Speaking of Russians, Luke and I've been watching these like TikTok videos or Instagram live videos or whatever, one of those short clip videos, and it's like, oh, America has the best whatever, or Canada has the best, crab or best whatever. Like it could be anything.
Yeah.
It'll be like, oh, we have the best police in the world, or just anything that's the best, and then that'll say meanwhile in Russia, and then they show you the Russian version. It's hilarious. You have to Google it. It
Okay,
is
so
hilarious.
send me the link. Do I need to have an TikTok account though? 'Cause
I will have
used
to ask
do that.
Luke because he sends me all the links, and it's like, oh, in America, this is what the best crab looks like, and then in Russia, and it's like a crab holding like a butterfly knife and like chasing after you and stuff.
I
It's
have
like
that
it's
picture.
hilarious.
Do you know what's funny? My brother went to Russia, and I remember him telling me the story. This was back in the 90s, I guess. And he's on the bus, and he looks over, and he says, Kev, I'm on this bus, and I'm going down a highway. It's like the size of the 401. And we're doing 60 miles an hour, 100 kilometers an hour. And I look over, and this is dead of winter, like January or February. And it's like minus 25 degrees out. He says, I look over, and he says, I shit you not, there is a Lada passing us. And the Lada has no doors, no windows, no windshield. Just sums up Russia. Okay, I know Patrick wants to make this a quick one, so I'm just going to make 2 quick recommendations for those that are looking for TV shows or anything. First is Dope Sick. Did I talk about this already?
Yeah, we did.
Oh, I did, so forget
last
it.
week.
It keeps coming. It's awesome. Second one then, so I'm only giving one recommendation, The Alpinist.
The what?
This is
Alpinist.
about the climber.
Yes.
Yeah.
Awesome.
Patrick heard something
it is.
else, but we won't talk about it.
It's The Alpinist. It's a great. Let's just put it this way: there's this fellow in Canada that does solo climbs, and you know there's that one guy that went and did El Capitan all alone,
Like like freehand or whatever.
yeah,
like
and
no
he's generally
strings or
considered
anything?
the kind of godfather of free climbing.
Yeah.
He looks at this Canadian dude and says that guy's crazy.
Oh, I think I saw the trailer for this.
Yeah. So
Yeah.
watch it. It's good. I believe it's on Amazon, although sometimes it's different for Canadians and Americans. What gets on Amazon for us ends up being on something else. But if you're looking for it,
Google it.
great. And if you're scared of heights, don't watch it because I had times I had to look away.
Oh,
Yeah.
I see.
It's good, though. It's like good. It's an hour and a half or something really interesting.
All right.
Okay, so we'll call it a day. There we
Yeah.
go.
All right, that was a great show, and let's see what happens in the markets next week, and we'll catch up next week to continue this beer drinking.
That's right. Take care, everyone. Thanks for tuning in. Bye-bye.